Good morning, everybody. My name is Kevin Uphill, and I'm the chairman of Avondale Corporate. And welcome to Vendor Assist, Vendor Due Diligence, Preparing Your Business for Sale, our webinar this morning. Now, we've got about an hour. Half of that I'm going to talk through with my colleague Stuart Millington, who's joining us. He's one of our strategists. The concept of Vendor Assist, what it is, how it can help you or your clients in preparing your business for sale. It's a relatively new trend. I think it's an important one. So we're going to talk through the technicalities for half an hour or so. Hopefully then, with a bit of inspiration, we'll get some ideas and knowledge across to you, and you can then throw some questions back at us and get involved in the dialogue so that we all build knowledge together. So that's the purpose. As I say, we've got about an hour. Don't worry, we will be recording the session, so if you don't need to scribble and take lots of notes, and it will be sent out to all delegates and attendees going through. So, Vendor Assist, and how does that help you and your clients prepare companies for sale? Well, the first thing is that, oh, hang on, it's not changing the slides again. There we go. Right, okay. So the first thing is, I want you to imagine that you've got a house and you're going through a house sale. And this is an analogy. You would not put a valuable house up for sale without preparing it for sale. You might get interior designers in, you might get the landscapers in, you dress it a little bit for sale. But also, you want to make sure it's structurally sound and increasingly in the high-tech age, environmentally sustainable. And preparing a company for sales is exactly the same thing. Vendor Assist is effectively the pre-sale survey. Now, normally buyers would do due diligence on your business, and that has increased post-COVID. We've got one at the moment for a very sizable transaction where we've got over 40 advisors in the data room, so heavyweight due diligence. And Vendor Assist is a form of pre-sale due diligence. So it's bringing forward that bench testing or check, or if you like using my analogy, house doctoring pre-sale, so that we get a prepared asset which has already been bench tested. Now, the advantage of that is it means that when you go into a transaction room with a buyer, the information is more prepared, the presentation is stronger, the sustainability is being pulled through, the transaction flows more easily, and therefore you get more bids. But also when you go into a process, that process is quicker because the information is sale ready. I call it sale ready, anytime, real time. And Vendor Assist helps you to get there. So how do we do it? What do we do for people? Well, those of you who know us, you know, we've been running M&A for 30 years, but increasingly in the last 3 to 4 years, we've been putting tech center of our process, and we've been running data rooms for projects in terms of sale marketing data rooms, which helps attract global buyers. And what we've done is we're using that tech, so proprietary data room, in order to bring forward a check on your company, benchmarking the pros and cons of that company, and scoring the pros and cons of that company. And that check, so we put the data room together, we build it with the existing management, and we use that to do a light form of pre-sale due diligence. Within that, you see we've got valuation, finance review, legal review, business review, technology, and then a scorecard. And I'm going to go through each of those in a bit more depth in a second. So as I say, we're looking to create this when, not if position, sale ready, anytime, real time. So clients that are engaging in Vendor Assist typically engaging between 2 years and 6 months out. There is a soft benefit to Vendor Assist at the moment, and that is that it's also enabling us to judge better the timing of the sale as clients are recovering from the pandemic effects. So, you know, tracking the finance run rate while still getting sale ready is an important part of the equation. But say step one, you put the data room together, then you review all the areas and the metrics line by line, and create a red flag report. Step 2 within it, we do a gap analysis. So obviously we don't set the value, but the market decides the value, willing buyer, willing seller. However, we've got a lot of comparative transactions we can go at. So what do we think it's probably worth today? What do we think it could be worth if we make changes? And you know, you've got that house doctoring analogy, but some of the changes, and this is where I think we're winning on the sort of vendor assist process, we don't see it flat. We do not see it simply as a line by line red flagging report. But we're working our work through the strategy team. So we're also doing a 360-degree review of the business and the business model. So that helps us understand, again, timing, if it's worth this now, what might it be worth tomorrow with certain steps that we could take, but we're doing it off an empirical foundation of data, which is built across the data room. So not just an initial, hello, well, we think possibly this, but a full in-depth analysis of the opportunity available and evaluation gap that we may or may not have in sale preparation. 3, of course, you know, when you put together a data room, you imagine when you go to market, you know, you've got these buyers, 40 advisors in that transaction I was talking about. Now, look, that's over the top. That's a big transaction. That's 40 million, but most would be typically 10 advisors in the data room. One of the key areas they'll be going over is the finance. Now, most of our clients, emerging mid-market businesses, we're specializing in sales between, say, 1 and 50 million, do not have a full-time finance director, or if they do, they've never been through this process before. So going early and helping them, show them what it looks like in the buyer's mind and how the buyer sees it is really critical to gaining value, because sure, there's lots of other value markers, but in the end, profits are the measure of your goodwill, right? We're interested in return on investment as buyers and sustainability of that return on investment. So the more we can do to present those numbers, are your KPIs right? What are your churn rates? Can you produce accounts in real time? Are your management accounts accurate? Are you putting in enough provision for corporation tax? We had one where we were looking at all the zero outputs, and they were doing the PAYE gross not net, and it was a mess. So yeah, those kind of areas where we could tidy up pre-sale save a lot of bother when you then go into a transaction later on. So it's working with the finance team to show them what that looks like, and also senior management to help them from the forecast point of view. Of course, any buyer is going to want to do legal due diligence. In the vendor assist process, you're doing a light form of that. So we're not doing full-blown legal due diligence. That's too expensive for sale preparation. I will talk to you about costs in a minute, just so you get a feel, so you're not too scared on the cost, because actually it's the big economies with the vendor assist process to an actual sale process. But I'll go through that in a second. So legal, you're doing a light form check, again against the proprietary data room. You've got all the contracts, supplier agreements, arrangements, property lease. Where do we think the problems are? Are there change of control issues? Are there lease commitments we want to try and get out of? Are there legal problems, litigation? Just looking for showstoppers. Just to share a story, that we had a security company. I remember this well. We'd agreed to deal with PLC. It was a really nice deal for my client. Multiple was really up there because they got strong recurring revenue, but the profits hadn't been that strong. But it was a very good deal, partly because they had some IP. But when we started looking at the contracts, their contracts had uncapped liabilities on warranties, and it was a PLC, and I just said, well, we can't take that on. So we couldn't sell it. That deal didn't go ahead simply for that reason. So that's the kind of showstopper you're looking for early on, before you go to market. Sale ready anytime, house doctoring, prepare that house for sale with your pre-sale survey, if you like. Now, I say we're taking vendor assist beyond. Vendor assist actually comes from the big accountants. They are doing it. The way they are seeing it is more where you've already got a company that's gone to market, but you're actually doing due diligence that the buyer might be able to utilize. and we're doing a form of that. But as I say, it's a light touch form simply for cost in terms of emerging mid-market. But actually, where we think it's clever is if you do that red flag report, that's the house doctoring side, we can also do a bit of the property development side for your business. So what is the strategy? How can we look for multiple influences? Is there anything we can do for positioning, cost reduction exercises and those sorts of things? So, you know, it's very difficult when you're running a business to be objective. An objective empirical business review can identify opportunities that you've not spotted to gain margin, but also position the business to influence multiple when selling. So we go through line by line in the data room, but these are some of the areas we're looking at. And ultimately, what we're trying to do is create a report and a feedback to the management of some of the actionables they can do pre-sale to get sale ready anytime, real time. Okay, and to give you an idea, I'm not going to go through every single point of this or say this is going to be shared after the event, but we recently did a vendor assist on a client that's looking to do private equity in the next 18 months. When we went through, we identified about £250,000 worth of cost savings for them, predominantly around outsourcing. Now, they have also used that to not necessarily run redundancies, but redeploy some of those people. So where they would have looked to recruit, they've now been able to redeploy. And actually, we know from our own experience, post-pandemic, we've invested more in our AI and our tech, and we've been able to do the same. So some of our support staff have now moved over to the marketing staff, and it's actually been a real pandemic success. So operational efficiency and technology are all areas that we would look at when we're doing a vendor assist review. So I'm not going to go through line by line, but when we do a review, it's red flag report, and also what do we think of the business model around multiple influences. We can't ignore tech when we're doing that. Every company today is a technology business, and increasingly, particularly again with emerging mid-market businesses, we think technology is going to be a value influencer. You know, how good is the platform? How good is the tech stack? Does it join up? Are there islands of information? Does your CRM talk to your account system? And are there economies of scale within all of those equations? So a technology review is important. Again, in a vendor assist, it's light touch, but if we're identifying detail, we may turn around and say, actually, we think there's a real value to a full technology detailed consulting and change management approach around your platforms, and that you'll get ROI on that in a sale. So it's a light touch review, but followed, if needed, by a detailed technology investment review. This is an example of a scorecard that we might put together. So obviously value is influenced in buyers' minds by sustainability. Sustainability is influenced by risk. So of course the biggest areas that we're looking for when we're red flagging are what are the high risks. So, you know, do we think the business is over dependent on the owner? Are we presenting the information correctly? Is the dashboard weak, strong? And you get a feel for the sort of way we would present the review and the feedback as you look at it. And obviously you can't change anything, but the key is to give you a report so you and your management know the key areas to work on, to focus. I'm mindful, by the way, we've got some management consultants in our participators today. We have actually shared some of our data room tech with other management consultants and some of our sort of red flag scorecarding stuff. We're not charging for that. It's on the understanding that we'll get the M&A process. So we don't have to be running the full vendor assist ourselves. There is a hybrid model where if you want to help your clients, and we're more than happy to talk to you about that if you're a partner, because we're passionate about this. We think the more prepared you are, the more value you'll get on the way out. And of course, hopefully, that means happy customers and more recommendations and referrals for us. So this is something that perhaps Stuart will talk to you more about in a minute. I'm going to bring him in. But ultimately, when we're doing vendor assist, we're looking not just at the red flag, but we're looking at the multiple influences around the business model. So I just said, for example, where every business today is a tech business, we think increasingly that's a multiple influencer. What can we do to play to that in the marketplace to gain advantage? How can we align the business model to a higher multiple business rather than a lower multiple? So price earnings ratios in smaller companies run between 4 and 10. What can we do on a red flag basis to move a 4 to 5? What can we do on a business model basis to move a 5 to a 6? And that's what we're looking at with vendor assist. That's our approach and process. So it's a bit of house doctoring, but also a bit of property development within the equation, all built around the data room. So it's empirical, light touch in terms of the time involved for both sides, and therefore cost effective. And very easy to manage because, as I say, it's all being done through the tech. To just give you a flavour on costs, because that's normally a question that will come up. Look, not all advisors are running vendor assist, so we're probably unique in the M&A market of doing vendor assist on an empirical basis, or also a business review basis. We think that's important. So, of course, we would argue that there's no comparison from a cost point of view. But also, I think the key is that with vendor assist, it's actually half of it is stuff that we would normally do when we're running an M&A process. All we're doing is bringing it forward 6 months beforehand, or 18 months, depending on where you are in your cycle. And therefore, there's a significant cost economy between running an M&A process. Let me give you an example. If we were running a deal for a couple of million value, typically we would have a commission on the back end. We would also run a 4 milestone basis. And every advisor is different, but this is just how Avondale works. So we would have a preparation fee for doing the data room, the information memorandum, and really just giving any quick guidance on what needs to be done to get it sale ready. Launch fee, research, and multi-channel reach out to the buyers. Each fee stage would be 7.5 grand. So on 2 million, 7.5 grand on prep stage. Launch would be 7,500. Then we'd have a fee on first viewings, and that's when we're moving into the buyer phase. Again, 7,500, and then a fee at offer agreed, 7,500. Now, if you're interested in vendor assist, all we do is we bring forward the preparation and launch fee, and we don't charge them when we go through a sale process. And the logic behind that for us is, yes, you're getting 2 milestones free when we do a sale process, but we are so confident that that sale preparation will work that we will get a higher commission at the end. But also, we are confident that by doing that sale preparation, the transaction process should be easier, and therefore we will have less work to do. We're not paid for work, we're paid for ideas and value, and basically our idea is that we will have to work less hard to get top dollar for your company, the more prepared it's been. And so this is a really clever way of creating that preparation, both empirically and from a business review perspective. Now, look, I've talked at you for quite a bit, so as I say, we're going to be moving to Q&A, so hopefully you can engage back. This is a bit broader than vendor assist. We might also talk about shareholder value concepts, but I'm now going to bring my colleague Stuart in to get him to share some of his ideas around shareholder value, and also what we've been doing with vendor assist. So Stuart's been running a couple of these projects for us over the last 6 months, and how he's seen that working with clients and what they practically got out of it rather than theory. Stuart, good morning.
Good morning.
It's a lovely backdrop. I'm taking it that's not live.
Yeah, no, that's not live. That's Kevin and I are based in Reigate. That's a view from Reigate Hill, or down looking on Reigate on a sunny day like today. So it's very nice.
It is a lovely sunny day. So we're very pleased about that. So good. So Stuart, big picture, vendor assist and sale preparation. What are your thoughts? So I just should qualify. Stuart has sold a very successful company. Did quite a lot of work positioning that pre-sale. So he's been there. He also knows how buyers are looked. So it's not just an advisory viewpoint. He also knows what buyers are looking for, because he's been through that 10 plus advisors in the data room experience, and how many questions they can truly ask and how irritating it is. So Stuart speaks not just as an advisor, but also practical experience. Sorry,
Yeah.
Stuart. Yeah.
I mean, I think the two key words here are focus and planning. If you think about it, selling your business is probably for most people the largest financial transaction they'll do in their lives. So the whole thing that Kevin was talking about planning for it and focusing on it, and give yourself at least 6 months. And I would say that's actually cutting it tight. You need longer than that if you're going to get it together. And there's another reason for that. The hard facts are, and there's lots of research on this, and it's surprising, but for every 100 businesses, private companies put up for sale, about a third of them never even get a serious offer. And of the remaining 2/3, only about half complete, about half fall over during the process. And some research puts it lower than that. And the reality is that people who've got millions of pounds to spend are not stupid. You don't usually find someone who's not very bright with a lot of money. So you're dealing with people who are going to be very bright, very thorough, and if they need to be ruthless. And then the other point of this is you need to ignore a lot of the PR and what I call the golf club number, because there are people who sell their business and they say, oh, I sold it for 4 million. He doesn't tell you we only got 2 up front, and the other 2 million was a deferred on a ratchet that's so aggressive, which means you'll probably never get a penny out of it. So vendor assist is about actually making sure that your company is in that third that sells, but also there's enough ammunition in there to give Kevin and his colleagues the ability to actually be able to negotiate a really good price for you and a really good deal structure. And it's really important because at the end of the day, the cash in the hand is the bit you know about, all the deferred payments. And I'm not sure what percentage of companies are sold with a deferred payment, but it's quite high, isn't it, Kevin, where there's a level of deferment?
Yeah, I mean, most deals have sort of 70-30. We much prefer deferred to earn out, but most deals will have something like 90% of deals will have an earn out or deferred payment.
Yeah, and so the whole idea of vendor assist is not just to assess your business, but it's to actually explain to you the process. And it says on the side, focus on what's important. But when you get to the due diligence in the actual sale, and Kevin's talking about 10 people in a room, it's interesting. One of the reasons you have someone like Kevin is part of the actual sale process is to negotiate what's going to happen during the due diligence phase. I mean, the last time I saw my business, the company, which is German, tried to bring in so many people into the data room. It's horrendous. And the reason it's horrendous is because it's not just you involved. They're going to have all the data in the data room, but out of that, there's lots and lots of questions. And they'll want to ask you as the managing director questions, but the questions are so detailed, you'll have to bring in other members of your senior management team. And the reality is, while you're trying to do this, you've also got to hit the numbers. So you've got to keep on hitting the numbers to maintain the value of the business. So one of the things that will help you plan for is how you plan the resource needed to manage the whole process. Because at the time, giving you lots of advance warnings, so you can prepare all the information for the data room helps because it spreads the load over a period of time. But also actually at the point you've got down to the due diligence and they're parachuting in their tax assessments, their accountants, their product specialists or whatever else to go through everything. Because in the due diligence, they're doing two things. One is they're making sure that everything you've told them is correct. But the other thing is actually they're looking for any risk points that gives them the excuse to renegotiate the deal. So actually managing that whole process to make sure the deal closes and you get the best price is really key, and it needs to be planned for. You can't just turn up, because if you're not careful, you'll find it gets sucked in. It's terrible. And there's other little things as well that you might not have immediately thought of that we help you work with, which is that you can't hide it when that happens. So when are you going to tell the staff that you're selling the company, and how are you going to tell them? And how are you going to get all the people you need to cooperate with you to keep on board? So there's a whole plan within a plan about the management of the staff as well, which is really key. So the other thing on this one is Kevin mentioned through that, how do you drive the multiple? It's interesting, as a managing director, what you're normally focused on a month-by-month basis is maximizing the profit and managing the cash flow, because most small businesses are always focused on the cash. All of a sudden, the focus changes, because we're not talking about maximizing the profit, we're talking about maximizing the equity value with vendor assist. We want you not only to sell the company, but get the maximum equity value for it. And that means shifting your focus more towards multiple, because sometimes you get a far better return for your efforts by focusing on the multiple than you do on the profit. The last company I built up I spent about 10 years from starting from scratch to finish. I designed it for sale from day one, and I took an 18-month run up at selling it. but I got a high multiple and I sold it well and I got the bulk of the money up front. So it really does benefit if you focus on the key drivers to get the multiple to make the business the most attractive business possible. What you really want is to give Kevin the ammunition so he's managing an auction where you've got 2 or 3 people who want to buy the company and he's managing the auction and getting you the best deal possible. And to do that, that's funny, you need a plan and you need to stick to it and you need to be really ruthless about maintaining it, because when we do a vendor assist with you, we'll come up with a whole list of stuff that you need to address. Some will be easy, some will be more difficult. Some you may decide actually it doesn't justify the effort. But within that plan, if you're really going to go to market on time, you need to be rigorous about the plan. And the trouble is, a lot of plans actually are a bit of paper that people produce, put in the desk drawer, never use again. This needs to be a workable plan. I love the great quote from John Harvey Jones, who said, "Planning is an unnatural process. It's much more fun to do something. And the nicest thing about not planning is that failure comes as a complete surprise rather than being preceded by a period of worry and depression." It's really simple. If you want to sell your business in 12 months' time, and we give you a plan, you've got to have a workable plan and stick to it. Otherwise, when you get to Kevin, you're not going to get the price you thought you were going to get because the business just isn't ready. The other thing being is, as you're coming up to that point, the focus has moved from cash flow and profit to actually the multiple. But the other thing is you need to think of your timeline. So the point being is there's a lot of activities, if you weren't selling the company, you may proceed with, but with the sale of the company in mind, you need to say no. So you need to start thinking in a different timeline, a different way, because you're not managing the business on a long-term basis anymore. You're managing it for your personal benefit on a much shorter-term basis. So going through and looking at projects that you might in the past have gone with, these times maybe you need to change the focus of what your decision-making criteria is. And as Kevin just said in this slide, you just say no. The other point on there, can I take you up to, is which customers are truly profitable. If you're already looking at your top 5, 10 or 20 customers and doing a mini P&L, you don't need down to the profit, but just to the gross margin level. So you're really looking at what the cost is of running each of those accounts, the margin you make on them, what the true profitability is. You need to know that, because if you haven't got it, you're 90% certain you're going to ask for it in the data room. They're going to want to see where your profit's coming from within it. And there's a whole load of other stuff like that they're going to need. So there's things like in the process, if you've ever sold a business before, there's something called a disclosure letter. I think it should be called the disclosure book, all ones I've seen, because they're usually huge. And one of the things you do in the process is the lawyer who is representing you and selling the company will say, is there anything you want to disclose? Because if you put in the disclosure letter, the buyer can't come back on you. So writing a disclosure letter is part science and part craft and art. Because what you want to do is disclose anything you think it might be risky, but not make it look risky when you put in the disclosure letter. And all of a sudden you're asking, can you go back 3 or 5 years? So one of the things we recommend you do in vendor assist, it's a bit like having a logbook for the car. Every management meeting, board meeting you have, the last item on the agenda is there anything we want to make a note of for the disclosure letter? So when the lawyer asks you for it, you give them the big pile of paper and say, we're not sure what we should disclose, but these are the things we might think are significant. And you give it to the lawyer to work out. So there's little things like that you can plan that make things much, much easier, make the chance of selling much higher, and make the chance of getting a really good price much better. So I think
Tom.
I guess I just going to say was, I think the whole about focus is the vendor assist assesses your company, but it helps you understand what's going to be important about the actual business. We work with you. We normally do vendor assist as a workshop, because then we can really, you can talk to us, you can interrogate us. So the whole thing is about reviewing what you need. Think long, think hard. You need to review the capacity and capability of your senior management team on what is required for both the selling of the company and the running of the company at the same time, because you can't afford to do the selling well and have the numbers drop, or maintain your numbers but not do the sale process as well. So you need a clear, workable plan that everybody buys into, and focus on what you need to sell the business. Just say no if it's a distraction.
Very useful, Stuart. We're going to invite everybody now to run some questions, so please fire some in. We actually had some previously, so I'm going to try and run those, if that's okay with you, Stuart, just as chair. I did want to pick up on the word interrogator. I like that you use. So what we do Render assist, we're simply bringing forward a large part of what we would do anyway to go sale ready, but we're doing that, sorry, to get a sale data room ready for presenting a business to market, but we're doing it early, and then we're holding the mirror up. And I think the word interrogator is good. I just want to make it clear that we're not touchy-feely about this. We are challenging. If we don't like something, we'll say it. We think that's the way buyers are, and therefore there's a bit of tough love. So if you buy into this, you are going to be buying into a bit of tough love as an equation. But we do think it's really important to be objective when we look at it. And we've also said sale ready, anytime, any real time. I should qualify that's also investment ready. So the M&A market, the process has also increasingly moved over towards private equity being as strong as trade. The stats are something like 50-50 now between private equity and trade. So sale ready is investment ready, and private equity are professional buyers. They are more thorough than trade on due diligence because they don't necessarily have the synergies and economies of scale to soak up some of the weaker foundations that you may have. So this has become more important to address that element of the market, the sale preparation. So Stuart, just sort of a couple of practical questions. When you've done this previously, how have you found our reports gone down with people? Have they liked it? Gasp of tough love. How's it gone down?
I'd say the shareholders usually love it. Sometimes the management are a bit aghast because it just changes their focus in terms of doing that. Because what we're doing is we're looking at how you can maximize the value of the business, and it does require a shift in focus from the management. So where the management are shareholders, they love it because they can see what they want to do. But where you have a split between shareholders and the management are not necessarily maybe shareholders or very minor shareholders, they all of a sudden are asked to go in a different direction. And there's one of the key things here as well is if the management that you need on board to sell the company are not benefiting from the actual sale of the company, you sometimes can run into problems.
Yeah. I think, and that's important as well. I mean, yeah, we do like to interview the management when we're running this, but I think because you can bring the angle of investment in, you don't necessarily have to be talking about sale ready. It can be investment ready. So it gets rid of that confidentiality issue, and you can also do it as an exercise in we're just doing a business review because we genuinely have a standalone management consultancy service and strategy. If you are worried about confidentiality with the management, it's not necessarily that you have to be utterly transparent with them about the ultimate goal of if that is the case, a trade sale or what have you. Just sort of running through some other questions, Stuart, that we might see. Why do you think people don't invest in sale preparation? Because we're big advocates for it, but a lot of people do sidestep it. They think they can go without it. They think it's a corner they can cut.
Well, it's interesting. I think it's a great question, and I don't want, being honest, I'm not sure what the answer is. But what you've said is astonishing because often you get a business, you look at the numbers, and you know that the management team have got to be a good commercial acumen because they wouldn't be able to run a business like they are and deliver the profit. Yet when it comes to selling the company, their motto seems to be leave no corner uncut. You tend to find people, they don't allow enough time, they don't have enough preparation. They try and make do with their existing solicitor because he's good, they know him and he's cheap. But in actual fact, he last sold a business 4 years ago and he's a bit rusty. There's a whole load of stuff there that sometimes it's amazing. They actually spend all this time, effort, years and years with their own money at risk building this business. And when they come to actually selling it, they just seem to run for the line as quick as possible, as opposed to actually approaching it in a really commercially planned method. And the word that's coming to mind was cold. You've got to be absolutely cold and focused on this. You've spent years building an asset. Don't just cut and run. Actually plan the actual sale really well. And I don't really, I've never got a satisfactory answer from anybody who's tried to come into us and sell a business where you go, well, hold on a second, it's not going to sell in 6 months because frankly, we're going to struggle to sell it in the current condition, and you're not going to get anything like the true value on it, you know. But if we work together for 2 years, we might get a significantly greater value. And they look at you aghast. They just imagine the business is going to sell.
I'm going to go for it, Stuart. I'm going to offer an opinion as to why they don't do it, actually. So if you look at it, it comes back to most board meetings end up as management meetings. So are the operations any good? Is Fred any good at his job? And they aren't strategy meetings, you know, new products, strategic alliances, acquisitions, shareholder value, how do we manage the multiple? And that is because people don't fully understand it. But ultimately, I still think it's because people feel guilty doing strategy work. It doesn't feel like work. It's not an immediate outcome. Whereas chasing the next contract, winning the next big client, looking at the P&L always feels like work because it's a real-time impact on the business. So just feel uncomfortable because they can't prove the ROI. Would you agree with that challenge?
Possibly. Yeah. I mean, the reality is I don't really know because it seems such a crazy thing to do, you know?
Yeah.
I mean, I tell you, my last business, I spent just over 10 years building it from scratch. I designed it from sales from day one, and I took an 18 months run at it, and I've been working on it for 10 years, and I got it right. And so when people come to me and they haven't actually planned the business for sale, they're just sort of saying, can we just go and sell it now? And you look at it and go, well, yeah, we could, and we'd probably be able to sell you, but you know, if you're patient and work for 18 months, 2 years with us, we'll get you a much better price. And it's astonishing, actually, somehow some don't want to put the effort in. They just want to sell now, cut and run. I don't understand the logic behind it. But I mean, the point being is you have to come back and respect people. It's their business. They own it. They can do what they want with it.
Well, there may also be some logic on tax risk at the moment, but there are other webinars about that you can look at on our website, but that might be some logic to that. Now, Stuart, we've had some questions, so just going to run some of those, if that's okay, as well, between us. So this one from David: in my experience, it's not uncommon for some owner-managed business management accounting to be a bit lacking and can adversely impact on the deal. What are your thoughts about fixing this, using a company's existing accountant to help versus outside help? Basically, do you try and fix it in-house, or do you go out of the company to fix it? I think it just depends on the skill set. I mean, one of the ones we did recently, we weren't very impressed by the finance director, actually, and one of our recommendations was that, we didn't think they needed them, and they do outsource to some professional accountants, and that was that by changing the accounting team was going to save 75 grand a year. I think I would lean towards moving elsewhere if the incumbent accountant hasn't got it sale ready or thought about how to prepare it. They may not be the right people to help sort it out, but it's a conversation. I mean, clearly, we get a lot of recommendations from accountants, and where we get that, those guys tend to be more proactive. So in that sense, we would almost definitely be working with the existing accountant to try and resolve any issues or challenges. So it's not just presentation, but it's also things like VAT status and all of those kind of things that we need to look at. I can remember doing a food business where we spent hours and hours debating when's a cake a biscuit and a biscuit a cake for that, to get that across the line for due diligence. It's that kind of stuff. Some other questions. I
just mentioned something else, Kevin, on that one. Is the reality is there's two things there. One is we often come in on the outside. The one that Kevin referred to, we worked on together, and we really brought it down. We asked them how many transactions the accounts department did in a month in terms of buying and selling, so invoice generation and invoices to be paid, and did a work and looked at it and just said they were completely overstaffed. So there's things like that we can do with help with. But the other thing is, I would challenge the actual existing accounts department to say, what are you going to do different? Because if you want to get a different outcome, you got to change what you're doing. What was it? Einstein said his definition of madness was doing the same thing over and over again, expecting a different outcome. So
on that, that's brilliant. We've had a great question in, which is, what are the 5 main things that a company has to prepare in order to sell? So I've also got some questions on costs. So I'm going to flip back to those in a minute. But what are the 5 main things that a company has to prepare in order to sell?
I
in
think,
your view?
yeah, I mean, I think it's distilling the top five. The first thing, if you like, is overall in the company is risk. Kevin mentioned it earlier on. It's really simple. The higher the risk in the business, the lower the multiple. So a business that's got contracted recurring revenues, low client churn, good relationships are going to do really well. The other thing is though, you have to why are people going to buy the business? They've got to see some growth. So there's two or three ways of doing this. There is they're buying the business because they can bolt you on and get rid of all your staff, which does happen occasionally. But in there, what they're going to want to do is they're going to want to see that the contracts are solid. There's a risk involved with that because most contracts have got a change of ownership clause, which means that the ownership change, the client can leave. But the first thing I think is the recurring revenue that de-risks the business. The second thing I think you've got to look at there in terms of making it successful is the company's actually going somewhere. So if you're buying a company, what JFK once said, the best time to fix the roof is when the sun's shining. So if your business is doing well, it's a good time to sell. And unfortunately, you tend to find owners go, oh, the business is doing really well. I'm going to make a nice profit this year. I'll leave selling it. And then the business, oh, we're having a tough year. Let's sell it. The time to sell the business is when the business is doing well. So I think timing is really, really key. So there's recurring revenue. I think the timing of the business, so that the business is performing well. I think there's the positioning of the business itself in the marketplace. Is do you have a positioning? Kevin had a business he sold a little while ago, which was a web domain business where people went there for advice and guidance and got signposted to people who could provide the actual service. And when we put it up for sale, we gave it a value based on a high multiple on the profits. Well, I can tell you there ended up being an auction going, and the price Kevin got for it, I think maybe a new record in the industry. And it's because the business was positioned so well and they could see how much they could do with it. So I think the third thing is about how the business is positioned within the actual sector itself. The other thing is, I think that when people look at a business, even if they're going to actually merge it in and lose some of the staff, they want to see the business is resilient. So what they're going to look at for is the quality of the management team and the quality of the systems and the processes. Because if you've got a business where people are doing it on the fly all the time and people are working hard, but there's not a documented process, it's very difficult to manage. So I think the key thing here is actually you've got a good quality management team, you've got well-documented processes, and the business is run in a professional manner. And I think the final thing is it's important that the shareholders have a minor role in the company, because by the time you sell the business, it's really important that the people who own the business and are leaving are not key to the actual business. Because if you get it and you find the biggest client of the business who accounts for 15% of turnover and 20% of profit, but the account manager looks after the client, is the managing director who owns the company who's leaving, that's a high risk. So one of the things to do is to make sure by the time you leave, you sell the business, the shareholders are actually have been sidelined effectively. They're not running the business. The last business I sold, about a year before I sold it, I moved myself to chairman, put a group CEO in place, and took a step back. I went in the business 1 day a week. I mean, I was maybe on the phone to him every day, but I was back in the office, which meant there was a double whammy. One is I wasn't a risk to the business. The other thing, interestingly, another little bit, my salary and cost were a right back into the business. And I don't know if you don't know about right backs, it's a separate conversation with Kevin, but it's like take vendor assist. Vendor assist is a non-recurring cost. So it doesn't come off your profit. When you're looking at the actual performance of the company, we would write the cost of vendor assist back into the financials because it's a one-off non-recurring cost. If you can actually remove yourself from the business and show that you're not running on a day-to-day basis, all the salary and costs associated with you can be written back in the business because you're not involved.
So just picking on that, Stuart, because I agree it's important to do a bit of an update on the market as well at the moment. So we have 5 M&A advisors. So when Stuart's saying Kevin, he means the Avondale M&A advisors across the team. They are all incredibly busy. What's happened post COVID, as you know, there's a super abundant capital. There's lots of money chasing too few opportunities. Organic growth is incredibly slow, and that's pushing people to look at acquisitions. So when you've got slow growth markets, economies of scale and synergy are far more important in terms of driving shareholder value for trade buyers. But also when you've got this super abundant capital, limited growth, people with lots of money building up, potentially worried about the cost of holding that money on account, they are then looking at investing that in private companies. So there's too few opportunities, but we are very busy, and what we're really finding is that quality does pay. So we do think, if you said, well, what are the impacts post-COVID? I think people are much more cautious about the business model and the sustainability of the business model, because we all know that it's going to be a pretty tough ride. So to use an analogy, we may not be in the full storm yet as the economy weathers the payback from the pandemic. They want to make sure that boat is utterly watertight if they're going to go sailing. And so buyers are much more cautious on due diligence. We've had the question here, can you explain what you mean by 10 people in the data room? Well, data rooms are virtual, so it is an event that takes place, but it is literally people, advisors going through line by line the data and the presentation of your business and creating questions, looking for risk and challenges in the business model. Is the boat watertight, isn't it? And people are putting more money into that because the risks are potentially higher because there's more volatility in the market. Now, look, I do want to make the point that we've got, the vendor assist concept. That doesn't mean that if you think you're sale ready, you're not. I mentioned tax risk. There are many companies that are sale ready, and we run a vendor assist and we go, do you know what? The timing's now, let's hit it. Because of that super abundant capital, the market is highly acquisitive. So, we may start a vendor assist process 18 months out and accelerate it forward due to various market trends and also your business and business model and where it is. We had one client we ran this through and we said, look, typically a vendor assist process is 3 to 4 months as a sort of gentle process. And they said, yeah, right, we're engaging you. The next day we got the data room. What they hadn't told us is they'd had a poor advisor and a failed sale process, so it was all there already. So clearly we could do our work a lot quicker. So it's a key part. I've had some questions on costs. I mentioned earlier, the fees I mentioned earlier were for a £2 million business. If the business is bigger, that was 2 million value. If the business is bigger, then clearly, of course, the work involved is deeper. We do quote that on a case-by-case basis because also it depends, how many companies are there? Are there holding companies, divisional companies? So I can't give you a full quote, I'm afraid. But the price obviously goes up the higher the value, because normally the larger the infrastructure, the more work there is involved. But we're more than happy to talk that through if you've got other cost questions. So happy to do that. So in fact, I think I've covered this for Glenn. That was a question that came in. So has anybody got any other questions they want to run through whilst we're here? No? Okay, that's good. So I think we're running on time, Stuart, for once, which is good. Have you got any? You think what do you think going to happen with the economy with the next 5 years on M&A? And your because you've been an entrepreneur and advisor, but you're also chair of a couple of companies. What do you think is going to come through?
I actually think as we come out of the I think as we're coming out of the pandemic and people have actually got more confidence, there's a lot of businesses, this is sad, but a lot of businesses they're fundamentally sound businesses that have been really badly hit. And some businesses are going to struggle as they come out to survive. And I think the stronger businesses that have managed their cash well and have got actually access to funding are going to be making a lot of acquisitions, and they're going to be fortunate because I think there's going to be a lot of fundamentally sound businesses out there in cash problems, and they're going to be therefore liable for it to be acquired. And the companies with the strategy and the access to funding, they could do really, really well and grow very, very quickly. And I think, interestingly, one of the things that would be worthwhile monitoring is what bits of the industry, of the economy, are going to grow coming out, because I think the pandemic has changed the way we live and where we work, and that fundamentally will cause some changes in what the markets that grow and don't grow. I mean, the obvious ones, things like online's gone through the roof. We all know that, working from home, etc. But I think there'll be a number of others, maybe not so obvious, that'll start emerging. And the people who actually are thinking strategically and monitor those could do really well out of it. So I think it's if you're in the fortunate position of having a business that's actually survived or done reasonably well over the last 18 months, you could be in a very, very good position over the next couple of years to take advantage of some people who unfortunately are not in the great nice position you're in.
Yeah, from an acquisition point of view, I do think the other trend is, I said it earlier, but I'm going to say it again, every business is a tech company. I think that COVID has accelerated technology transformation. People have been forced to change habits around virtualization. I think that's here to stay. And I think too often companies have seen IT as an outlying department of geeks rather than placing it center stage in their strategy. How do you use tech to make your business model more efficient and in the upper quartile of gross margin for your sector? And I think post-COVID, buyers have suddenly grasped that. So they're going to be looking at that in far more depth as they go forward. Okay, well, look, I think we're on track. I think we've probably covered it. If there's no more questions coming in, I'd like to thank Stuart your time this morning. Very appreciated. And I'm hoping everybody stays well. As I say, we will be sharing this webinar. So if you need to share it to your colleagues, friends, advisors, please do. We've got some other events coming up, I should mention. Exit strategies, I think actually we've just delayed that date, so that date's wrong. But if you want to know the date, I think it's 15th of July or something like that. So do email me if you want to know the very latest date for that. We're going to be doing an M&A update on trends and structures because there are a few nuances around deal structures that have changed. And then, of course, with 50% of deals now also being private equity because they are highly acquisitive, we've got to understand that. So we're always running a series of events around that. So we've got that on the 4th of November. So stay well, everybody. Really appreciated listening, and we look forward to catching up soon. Thanks.
Thank you.